Hello, everybody, and welcome to this particular episode. And today, want us to talk about a trading plan. Okay, so I want us to discuss the trading plan because you realize that building a simple, repeatable trading plan is very significant, especially for each and every trader in the financial markets, because a simple, repeatable trading plan helps you to survive during even the losing streaks. Okay, so all I can say is that you realize that in most trading plans don't fail because they are bad. They fail because they collapse the moment losses show up. And I believe you have been a testament of this. Sometimes you have a very a trading plan that you think is really a good trading plan, only for that plan to collapse when you start maybe probably having some losing streaks. So, and if you realize that your plan only works when you are winning, it's not a plan. That's basically what you can call optimism. Every trader says they have a plan until they hit a losing streak. That's now when you test whether your plan is real a plan or maybe probably is just optimism. That's when rules get bent, risks get increased, and discipline starts to disappear. So in this video, I'll show you how to build a simple, repeatable trading plan, one that doesn't break even when things go wrong. So this video is for traders who have a strategy but don't follow it consistently, feel disciplined until few losses hit, change plans too often, or feel like their rules disappear under pressure. So here's the core truth. A trading plan is not designed to maximize profits. It is designed to protect behavior. Because whatever you are going to put in your trading plan, these are the rules that you are going to follow. A trading plan, in a very simple definition, I usually call it a trader's constitution. What is the work of a constitution? Constitution tells you the do's and don'ts. It gives you the rules and regulations. And if you break those rules and regulations, definitely there are the consequences. The same case to a trading plan. If you break the rules and regulations, the do's, the rules and regulation, if you break the do's and you do the don'ts, definitely there are going to be repercussions. And repercussions here meaning you're going to lose some good chunk of money, right? So if you can't survive losses, it will never reach consistency because losses are part of the game. That is one thing that I've been emphasizing. You cannot be 100% winning in the markets. There are those instances that losses come in. And these losses, if you cannot be able to survive the losses, you will never reach consistency. So why most trading plans fails, you realize that they are too complex, they are too vague, or they are too ambitious, or they are built around winning and not losing. So you need to have a simple, clear trading plan that is able to sustain you even through the losing streaks. So the common problems are basically you realize that maybe probably you have like 10 plus setup types that you trade, flexible rules that change emotionally, having unclear risk limits, no rules for drawdown, and know what to do when it goes wrong section. Okay, so that is the reason why you realize that most trading plans fails. We have said because of the too complex, being vague, ambitious. They are built around winning and not losing. And the reason why that happens, or the common problems why that happens, is because you find yourself trading more than maybe probably 10 plus setups. You find yourself your flexible rules, you have very flexible rules that change emotionally. When you have those emotions, fear, greed, you tend to change those particular rules. You have unclear risk limits, you're not consistent in terms of your risk. You don't have any rules for drawdown, and you don't have a session for what to do when it goes wrong. Okay, so a plan without laws rules is basically incomplete, and this is what I want you to understand today, and this is what I'll teach you today, how to be able to create a very simple trading plan that is able to accommodate even during those losing streaks. Okay, so and you realize that the market will expose that. It will definitely expose that, because you're not going to have wins all through the market. You're not going to have wins all through. There are those instances that you will incur losses. There are those instances that you will have some losing streaks. And during those instances, that's when now the market is able to expose you. That's when the market will really tell you whether your trading plan is indeed a trading plan, or it is just a shaky one, whether it's a solid trading plan or it's a shaky trading plan. Okay, so what you need to understand, there are purposes of a trading plan, why you create a trading plan, right? Or you need to understand the reason why a trading plan is very important. Okay, and let me begin by resetting your expectation. A trading plan's job is to reduce decision making, to standardize behavior, to remove emotions, and to create consistency over time. What do I mean by reducing decision making? Because you have already stipulated your rules in your trading plan. So you don't really need to like make a lot of decisions. They're already made in writing in your trading plan. So yours is to follow what you have put down in that trading plan. It will help to standardize your behavior, that you'll have a standard level of a behavior in your trading. And this is what builds consistency with time. It will help you remove completely emotions, right? So it will help eliminate emotions, because you have to cater. You have to cater in this trading plan when you are winning and when you are losing. So when you're losing, what do you do? Does your trading plan stipulate to you, if you're losing, you're supposed to do this and this and that? If not, then that's not a complete trading plan. So a trading plan is not there to guarantee you profits. Okay, a trading plan is not there to eliminate losses. A trading plan is not there to make trading exciting. No, a good trading plan makes trading boring. I can assure you that 100%. If you follow your trading plan to the letter, it makes trading feel boring. And what I can tell you is that that boredomness, that boring, is stable. That is the stability that you are looking into. So here are the 5 core elements of a simple trading plan. You only need these 5 elements that I'm going to share with you. Anything more increases failure risk. I assure you that. I have lived a testament of that. You only need these 5 components. If you had anything else, that is going to increase your failure. That is going to increase your failure risk completely. And before I share the 5 things that will help increase your trading plan, what you need to know is that, or what you need to do is that, if you have not really subscribed here, you are watching, you have not subscribed, please make sure that you subscribe, you like, you follow, you share this, so that someone else as well can be able to benefit from this content that I share here. I usually talk about risk management. I usually talk about psychology. I usually talk about even trading strategies. I also go live sometimes, live trading sessions, right? So let's get into the 5 core elements of a simple trading plan. Okay, so the first one that you should have is the market and session rules. The market and session rules. So when I talk about the market session rules, you need to define when you trade. For example, I'll give you very quick examples here. You can decide only to trade London or only to trade New York session, right? You can decide probably maybe only to trade the sessions overlap. You can decide not trading outside high liquidity hours. You can decide you'll only be trading within the kill zones, right? So this immediately cuts over trading because you have specific windows of time that you trade. And a plan that trades all day is a plan that leaks. I can assure you that. If your trading plan allows you to trade all day, from the Asian session, London session, New York session, all through when the market is open, you are trading. That is a plan that leaks and it will not survive, right? It will not survive. So the second element of a simple, repeatable trading plan, it should have setup definition. One model only. Please hear me and hear me well. One model only. So if you're trading different models, I don't know, you're trading supports and resistance. You're also trading ICT order blocks. You're trading ICT fair value gaps. You're trading ICT mitigation blocks. You're trading ICT rejection blocks. At the same time, combining different models, that plan will not stand the test of time. So you only need to choose one model, not three, not five, only one. Okay. So for example, you can choose a model, maybe probably you define it by the moment you see a liquidity sweep, then you want to see a shift, a structure shift or a shift in market structure, and then now you can take a trade. Okay. So that's one model, and you need to keep repeating that same model all through. You need to keep repeating that same model all through, right? You need to keep repeating that same model all through. You can have another model like probably breakout and pullbacks or breakout and retest and stick to that model all through. You can have a model of range high, low reversal. You can have a model like the one I do, the ICT order blocks. And you keep repeating that particular model. You keep working, looking at instances, some of the things that you can be able to do with this model so that you can be able to increase the probability, so that you can be able to increase the winning probability. Okay. So your plan should help you answer the question, what must happen before I enter a trade? So you have to have that described in your trading plan. What must happen before I enter a trade? What do I want to see happen before I enter a trade? What must invalidate the setup, or the things that you want to see so that you can say that my setup is invalidated, and if you're in that trade, you can exit the trade, or maybe probably you can maybe take profits if you're in profits. So if you can't explain it in one paragraph, remember it's too complex. And what I want you to know is that complexity basically makes things difficult. You're too busy for nothing because it's complicated, right? So you need to make it simple. Remember our mantra this year 2026 is KISS. Keep it simple and stupid, right? So the number three element of a simple, repeatable trading plan is that it has to contain the risk rules. That is non-negotiable. It has to contain the risk rules, my friends, non-negotiable. Okay, that is non-negotiable, non-negotiable. When I say non-negotiable, it means this is something that you must have, whether you like it or not. If you want to survive those turbulence times, you must have this. You must have this. Okay. So, this is the backbone in your trading, risk rules, because this is what is going to help you protect your capital. This is what is going to give you longevity. So in terms of risk rules, you have to define your fixed risk per trade. Maybe probably you risk 1%, maybe probably you risk 0.5%, maybe probably you risk 2%. You have to define that fixed risk percentage. I'm not saying variable, but I'm talking about fixed risk per trade. You have to define maximum daily loss. And I know most of the traders, they don't have this at all. They are always focused on profits, 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 profits. Okay, they don't want to look at maybe probably the maximum daily drawdown. And why is the maximum daily drawdown very important, or the maximum daily loss very important? It is because it's going to cushion you from over trading or revenge trading, basically trying to recapture or to recoup the losses that you've made. And in trading, if you over trade, if you revenge trade, then chances that you're likely even to lose more money. You have to define your maximum weekly drawdown. So you begin by actually the weekly maximum drawdown, so that now you can be able to determine your daily maximum daily loss, so that you don't have maybe probably risking like the entire weekly risk in one day. So your trading plan should define that maximum weekly drawdown. It should define your stop trading rules. What makes you to stop trading? Okay, so it has to contain that. For example, you can say that I'll stop trading after 2 losses in a day. I will reduce my risk or my lot size after 3 losing streaks or 3 losing trades. I will take a break after X% drawdown, because breaks are also important here. You need to take breaks. You need to rewire yourself, right? So these things I'm talking about, they are very important. Kindly don't ignore them. Make sure you put them in your trading plan, because if you don't do, you're going to pay the price for that. So, and the risk rules, the reason why they're non-negotiable, I said this is the backbone of your trading, and this is what keeps you alive. This is what prevents you from blowing accounts after accounts, right? So the fourth component in your trading plan, or the fourth component of a simple repeatable trading plan, is the execution rules. Execution is what turns strategy into results. So in your execution, you have to define where entries happen, how stops are placed, how targets are chosen, when you do nothing. Remember, I've always said many successful traders, not actually many, but successful traders, they spend a lot of time doing nothing. Why? Because they have a specific window of time that they trade. So if it's not within that time, they'll not be trading. They know the asset that they want to trade, and they have that one model that they want to see happen so that they can take the trades. So a lot of time you realize they'll be doing nothing. Okay. So make sure that your execution rules define where entries happen. Like for instance, in my execution rules, I use ICT order blocks. So I have to see a BOS, I have to see the displacement of price, and then I wait the price to come back to the order block. I have to mark my order block. Once I see the BOS, I mark the order block. I wait for the price to come to displace and come and retest the order block. And that's how my entries happen. And this should be within the kill zone. I only trade the London kill zone and the New York kill zone. Okay. So it tells me how to put my stops. Okay. So if I'm using the order block, I have to put my stop loss below the order block. It tells me how targets are chosen. So I do risk to reward ratio of 1:2. That's how I choose my targets. Or I can target the liquidity, the external liquidities. Okay. It also tells me when to do nothing, because if whatever I've written down is not showing up, if my model is not showing up, therefore I will not take those trades. I will not do anything. I will not take the trade. So basically what these rules does, they remove hesitation and impulse, because it helps me not to think under pressure. Okay, because I have all these rules put down, everything laid down. So no thinking under pressure, and also no hesitation or impulsive trading. The last component of a simple repeatable trading plan is you have to have a section whereby you have to review and adjust those rules. Okay, so your plan must include reflection. You have to have that reflection part, not daily over analysis, but weekly, right? That's what we do on weekends, on Saturdays. You do a weekly review of your trading plan. All right. So, I mean, you do a weekly review of your trading plan. So you look at the journals, because a trading plan, once you review it, basically what you're asking yourself is, did I follow the rules? Where did I break discipline? What mistakes are repeated? Okay. And once you have to understand this, and so that you can be able to get this, remember, you are also journaling. I think the last video I posted was about journaling. So you are journaling those trades. So you are looking at those trades and asking yourself, did I follow my rules? Where did I break discipline? What mistakes repeated oftenly? And a plan evolves slowly, not emotionally. So you'll be able to build it slowly. You'll be able to adjust those rules slowly as you get to know maybe your emotional triggers, as you get to know maybe whatever is the mistakes that are repeating themselves. So you keep adjusting slowly. So the reason I'm saying the trading plan will evolve slowly, not emotionally. Okay. So I believe we have captured those four. I believe you have captured, I mean, those five. I'll repeat them just by mentioning them. The first component of a simple, repeatable trading plan is market and sessions. The second one is setup definition. That is one model only. The third one is risk rules, and I said this is non-negotiable. The fourth one is your execution rules, and the fifth one is that you need to review and adjust those rules. So here is the gist. And this is the most part that a lot of traders or most traders skip. Your trading plan should design a plan for losing streaks, because what I can assure you, definitely those losing streaks will come. So your trading plan should design the plan for losing streaks. So your plan must tell you what to do when you lose. And what I mean here is that losing streaks rules must be included in your trading plan. And some of these risk rules entail how you're able to reduce risk if you have in those if you're in a losing streaks, or if you're in a consecutive losing momentum. So your trading plan should contain rules like how to reduce your risk if you're in a losing streak, pausing to trade when you should pause from trading, because pausing or taking breaks is important so that you can rewire your mind. Limiting the number of trades. You should be able, if you are doing like 3 trades in a day or 4 trades in a week, then if through a losing streak, if you are going through a losing streak, therefore your trading plan should define how you should limit the number of trades. Also, reviewing execution only, not strategy. It should also help you to review the execution, because maybe probably the execution is the problem. So you have to review it, not only the strategy, but also the execution. Why? Because this prevents revenge trading. Okay, this will help prevent revenge trading. And remember, losses are expected. You will always come through that losing streak. You will always have some losing trades. If you come across someone telling you that they don't lose, run away from them. Okay, so losses. So what you need to remember is that losses are expected and reactions are optional. Right? Why am I sharing all this? Because I used to build plans for perfect days. Right? I used to use plans to build plan for, for perfect days. Remember, I told you that I was introduced in that 90 days spreadsheet, whereby if I have $100, I compound in 90 days, I make my $1 million dollar. So that's what my plan looked like. So I didn't have my plan catering for those losing streaks, those bad days. So I only used to build plans for perfect days, and it didn't work, because markets don't offer perfect days. What they offer is stressed test days, because it will always test your stress. It will always test your stress. Okay. So, and the moment I realized this and I built a plan for bad weeks, then I started seeing consistency. I started seeing results trickle in. Okay. So in a nutshell, what you need to understand is that a strong trading plan is simple, it is repeatable, it is boring, it is loss aware, and it is behavior focused. So you don't need more rules. You need clearer ones. You need clear rules. So a plan that survives losing streaks is the only plan that reaches profitability. In the next video, ladies and gentlemen, I'll be talking about how to know if your strategy actually works or if you are just surviving on hopes and random wins. So make sure you tune to the next one. And until then, see you.